There is a fatal flaw hardwired into the most intelligent people among us. It's a dangerous instinct, a reflex that has built empires, cured diseases, and put humanity on the moon, but one that becomes a catastrophic liability when applied to the world of investing and finance. It is the deep, primal attraction to the complex puzzle. The brilliant mind sees a 7-foot hurdle and instinctively feels the urge to conquer it, to prove its own intellectual horsepower by clearing the obstacle. The world tells us this is the path to success. School rewards the student who solves the hardest math problem. Society lionizes the entrepreneur who cracks the most intricate market. But in the world of capital, in the cold, unforgiving arena of building real, lasting wealth, this instinct is a trap. It is the siren song that has led countless geniuses to financial ruin. And there is one man who, over a lifetime of unbelievable success, has built his entire philosophy around the deliberate and ruthless avoidance of this trap. Warren Buffett's secret isn't his ability to jump over 7-foot hurdles. It is his discipline in searching, with monomaniacal focus, for the 1-foot hurdles he can simply step over. This is not a lesson in simplifying your ambitions. It is a masterclass in amplifying your results by suppressing your ego. It is the ultimate mental model for avoiding the smartest person's trap. The core idea, the genetic code of this entire philosophy, is that genius in investing is not found in solving intricate problems, but in the profound humility of finding simple, predictable businesses with obvious qualities and stepping over the low barriers they present. This choice, this deliberate pivot from complexity to simplicity, is what ensures a higher probability of success and forms the bedrock of a financial education that can lead to true, sustainable wealth. It is the final promise of a rational mind in an irrational market. To truly understand this framework, we must deconstruct it into its 5 fundamental pillars. First, we will explore the very foundation of this philosophy, the absolute necessity of operating within a clearly defined circle of competence. This is the map that shows you where the 1-foot hurdles even exist. Second, we must examine the active and aggressive repulsion of complexity, the conscious decision to throw difficult problems into the too hard pile without a moment's hesitation. This is about learning to recognize and run from the 7-foot hurdles. Third, we will uncover the inevitability test, the specific qualities of a business so simple and so dominant that, as Buffett famously said, even a ham sandwich could run it and make a profit. These are the 1-foot hurdles themselves. Fourth, we will dissect the strategic power of inaction, the profound discipline of patience required to wait, sometimes for years, until a perfect 1-foot hurdle appears. And finally, we will connect this entire mental framework to its ultimate financial expression, the margin of safety, the quantifiable, numerical measure of just how low that hurdle really is, providing the ultimate protection against the mistakes that even the smartest people can make. This is not just an investment strategy. It is a success mindset, a complete system for decision-making that separates the brilliant but broke from the truly wealthy. Let us begin with the cornerstone of it all, the map of the entire territory, the circle of competence. This is the principle that dictates you must have a deep, practical, and almost intuitive understanding of a business before you even consider investing in it. It's not about having a high IQ. It's about knowing the perimeter of your own knowledge and never, ever straying beyond it. The world is filled with thousands of companies, thousands of opportunities. Your job is not to understand all of them, or even most of them. Your job is to define the small handful of industries you can understand with absolute clarity and ignore everything else. This is the first and most crucial filter in identifying the 1-foot hurdles. You cannot possibly know if a hurdle is 1 foot high or 7 feet high if you are looking at it through a thick fog of ignorance. The circle of competence is the act of clearing the fog in your own small, well-defined patch of the investment world. The foundational anecdote that cemented this pillar in Warren Buffett's mind and in the very DNA of Berkshire Hathaway can be traced back to a seemingly small and unassuming purchase in 1972. It wasn't a complex technology company or a sprawling industrial conglomerate. It was a box of chocolates. The company was See's Candies, a beloved West Coast chocolatier. At the time, Buffett and his partner Charlie Munger were looking for high-quality businesses to acquire, with the cash being generated by their textile mills and insurance operations. A man named Blue Chip Stamps, which Berkshire controlled, was presented with the opportunity to buy See's Candies for $30 million. The company was earning about $2 million after tax, so the price tag represented a multiple of 15 times earnings. By the standards of the value investing that Buffett had learned from his mentor Benjamin Graham, this was expensive. Graham taught him to buy statistically cheap cigar butt companies, mediocre businesses at dirt-cheap prices that had one last puff of profit left in them. See's was the opposite. It was a wonderful business at what seemed like a high price. Buffett's initial instinct was to pass. He offered $25 million, and the See's family, the owners, held firm at $30. It was Charlie Munger who pushed him, who convinced him that paying a premium for a truly simple, high-quality business was a far better long-term strategy than buying garbage at a discount. Buffett relented, and they paid the $30 million. This single transaction would fundamentally alter his entire investment strategy. What did Buffett see in See's Candies? He saw a one-foot hurdle. He saw a business that was breathtakingly simple. They made high-quality chocolate in a kitchen, put it in a box, and sold it in their own stores. There were no complex patents, no reliance on ever-changing technology, no labyrinthine regulatory hurdles. He could understand its economics in 5 minutes. More importantly, he saw a durable competitive advantage, what he would later call a moat, that existed not on the balance sheet, but in the minds of its customers. See's Candies had pricing power. For decades, customers in California had been giving boxes of See's as gifts, for birthdays, for Christmas, for Valentine's Day. The act of giving the box was associated with affection and quality. This mental connection gave See's the ability to raise its prices year after year without losing customers. A customer who was going to spend $10 on a box of chocolates was not going to quibble over it costing $10.50 the next year, because the emotional value of the gift far outweighed the marginal increase in price. This was a business with predictable, repeatable earnings. Rooted in simple human psychology, it was entirely within his circle of competence. He didn't need a Ph.D. in chemistry to understand the product, nor a degree in software engineering to understand its distribution. He just needed to understand basic business and human nature. The results were staggering. That initial $2 million in after-tax earnings grew and grew. Over the decades, See's Candies would go on to generate over $2 billion in pre-tax profit for Berkshire Hathaway, all without requiring significant additional capital investment. It became, in Buffett's words, the prototype of a dream business. It taught him that the real money wasn't in jumping over the 7-foot hurdle of a complex corporate turnaround or a speculative new technology. The real path to building wealth was in identifying a simple, wonderful business you could understand intimately and then letting it work its magic for decades. The $30 million purchase of See's Candies was not just a great investment. It was the purchase of a mental model, a financial education that would guide every major decision in his portfolio strategy for the next 50 years. It was the moment he stopped looking for cigar butts and started searching exclusively for one-foot hurdles. The power of the circle of competence model works because it provides a powerful antidote to some of the most destructive cognitive biases that plague human decision-making. At its core, it is a weapon against the Dunning-Kruger effect and the pain of cognitive dissonance. The Dunning-Kruger effect is a well-documented psychological principle which states that people with low ability at a task tend to overestimate their own ability. In investing, this is rampant. An investor might read a few articles about biotechnology, learn a few buzzwords, and suddenly believe they are qualified to pick the next winning cancer drug. They mistake a surface-level familiarity for deep, specialized knowledge. Their small amount of knowledge gives them an unwarranted and dangerous level of confidence. They are standing at the base of Mount Stupid on the Dunning-Kruger chart, and from their perspective, the peak of wisdom looks tantalizingly close. This is where catastrophic mistakes are made. They invest in a company whose science they don't truly understand, whose clinical trial process is a black box to them, and whose competitive landscape is a mystery. They are trying to jump a 7-foot hurdle in the dark. Buffett's circle of competence is a rigorous, self-imposed system to prevent ever climbing onto Mount Stupid in the first place. By forcing himself to define the perimeter of his knowledge, he is admitting up front, here is the line. Beyond this line, I am a novice. This is an act of profound intellectual humility. He is not trying to be an expert in everything. He is focused on being a true expert in a very small number of things. The second psychological demon it slays is cognitive dissonance. This is the mental discomfort experienced when holding two or more contradictory beliefs or values. For an investor, dissonance occurs when they've invested in a company they don't understand, and it starts to perform badly. Their belief, I am a smart investor, clashes with the reality, my stock is going down. To resolve this discomfort, the brain does something irrational. Instead of admitting the initial premise was wrong, that they didn't understand the business, they will often double down. They'll seek out confirming evidence, ignore negative news, and might even invest more money, a behavior known as averaging down into a losing position. They do this to soothe the ego, to resolve the inner conflict. The circle of competence short-circuits this entire process. Because Buffett only invests in businesses he understands deeply, like See's Candies or Coca-Cola, when the stock price drops, there is no cognitive dissonance. He can re-examine the business fundamentals which he intimately grasps, and if they remain unchanged, the price drop is not a threat but an opportunity. His belief isn't I am smart, it is I understand this simple business. If the facts supporting that belief are still true, a lower price is a gift. This mental model shifts the entire foundation of decision-making from ego protection to a rational assessment of business reality. It replaces the emotional, gut-wrenching experience of watching a stock you don't understand plummet with the calm, analytical process of evaluating a business you know inside and out. It's why he could confidently pour billions into American Express during a panic or into Bank of America during the financial crisis. He wasn't guessing. He was operating within the brightly lit confines of his circle, and this gave him the psychological fortitude that 99% of investors lack. So how can you, an intelligent investor, an entrepreneur, a professional, apply this principle? How do you define your own circle of competence and turn it into a practical tool for building wealth? This isn't an abstract concept. It is a blueprint, a tangible mental model you can build and use. The first step is to perform a knowledge inventory. Take out a piece of paper or open a new document and create 3 columns. The first column is professional expertise. List the industry you have worked in for years. What are the things you understand at a granular level because you've lived them? If you're a software engineer, you understand the difference between SaaS and enterprise software models. If you're a doctor, you understand the healthcare system, medical devices, and pharmaceuticals. If you're in logistics, you understand supply chains. This is your most powerful earned advantage. The second column is genuine hobbies and passions. What do you spend your free time learning about? Are you a gamer who understands the economics of video game publishers? Are you a car enthusiast who understands the automotive industry? Are you a home chef who intimately knows the brands in the consumer packaged goods space? This is where your natural curiosity gives you an edge. The third column is explain it to a child. List any industry or business model that you feel you could explain the core economics of to an intelligent 10-year-old in 5 minutes. This is the ultimate test for simplicity. Could you explain how Visa makes money? How about Coca-Cola? How about a railroad? If you can't, it doesn't belong on this list. Once you have this inventory, this is your starting universe. Everything else, from biotech to cryptocurrency to complex derivatives, is off the table. You must be ruthless. Your ego will tempt you to add things you find interesting. Resist. This is a discipline of exclusion. The second step is to create a competence filter for every new investment idea. Before you even begin researching a company, you must ask one question: does this fall squarely within one of the circles I have just defined? If the answer is a resounding yes, you may proceed. If it's a maybe or a well, kind of, the answer is no. For example, if you are a marketing executive at a food company, a business like Hershey's or General Mills is directly in your circle. A social media company might be in your circle if your work involves digital advertising. But a company that manufactures semiconductor chips is almost certainly not. Your process for avoiding mistakes starts right here, by refusing to even engage with ideas that are outside your expertise. The third step is deep immersion within the circle. Once a company passes the filter, your job is to go deep. Read the last 10 years of its annual reports. Listen to its earnings calls. Study its competitors. Your goal is to understand the business so well that you could give a 1-hour presentation on it with no notes. You want to understand its competitive advantages, its key revenue drivers, its cost structure, and its management's philosophy. Because you are working within a field you already understand, this deep dive will be exponentially more effective and efficient than if you were starting from scratch in a new industry. This rigorous process transforms investing from a gambling game of hot tips and speculation into a professional discipline of research and analysis. It is the practical application of Buffett's core insight. Your long-term success in the stock market will not be determined by the size of your circle, but by how well you define its boundaries and how disciplined you are in staying within them. Now let's explore the opposite approach, the path that 99% of investors, particularly smart ones, tend to follow. This is the path of the antithesis, the way of the dabbler. The dabbler is an intelligent person who mistakes broad, shallow knowledge for deep, actionable expertise. They read the Wall Street Journal. They listen to financial news. They follow tech blogs. They are conversant in the topics of the day. As a result, they feel competent to have an opinion, and therefore an investment, in almost anything. Their portfolio is a chaotic reflection of the last 6 months of news headlines. 1 month, they're buying a cannabis stock because they read an article about legalization. The next, they're investing in a new cryptocurrency because a friend at a party told them it was the next Bitcoin. Then, they'll buy a few shares of a biotech firm after seeing a positive news segment about a promising drug trial. They are constantly jumping from one idea to the next, never staying long enough or digging deep enough to truly understand the underlying business. Their circle of competence is a mile wide and an inch deep. The dabbler's fatal flaw is that they believe their high general intelligence is a substitute for specific, domain-level knowledge. An brilliant surgeon might assume that because they can master complex surgical procedures, they can easily master the art of valuing a software company. An accomplished lawyer might believe their ability to deconstruct complex legal arguments translates directly to deconstructing a company's balance sheet. This is a catastrophic error. The skills are not transferable. Investing is not a test of general IQ, it is a test of specialized knowledge and emotional discipline. The consequences for the dabbler are almost always mediocrity or outright disaster. Because they don't truly understand what they own, they are susceptible to every rumor and every market gyration. When their biotech stock falls 30% because a clinical trial is delayed, they have no framework to decide whether to buy more, sell, or hold. They don't understand the science, so they can only react to the price and the fear. They end up selling at the bottom. When their cannabis stock languishes for a year, they get bored and sell it to chase the next hot thing, often right before the business fundamentals actually improve. They are perpetually whipsawed by the market, mistaking activity for progress. Their portfolio churns, racking up trading commissions and taxes, but never compounds in a meaningful way. The dabbler is engaged in a high-effort, low-return activity. They spend hours reading news and chasing ideas, but it's all intellectual junk food. It provides the illusion of being an informed investor without the deep nutritional value of genuine competence. This is the exact opposite of Buffett's approach of intense, focused effort on a few simple ideas, followed by long periods of inactivity. The dabbler's path is a frustrating journey of running in place, and it is the inevitable outcome of ignoring the first and most important pillar of rational investing. How does this rigorous discipline of staying within your circle of competence translate into a direct, quantifiable financial advantage? The connection is not abstract. It manifests in multiple powerful ways on your balance sheet and in your portfolio's performance. First, it dramatically lowers your unforced errors. In tennis, the amateur player doesn't lose because their opponent hits incredible winners. They lose because they hit the ball into the net over and over again. These are unforced errors. In investing, the majority of catastrophic losses don't come from unpredictable black swan events. They come from investors making bets on businesses they fundamentally misunderstood. It's the unforced error of investing in a complex financial firm without understanding its leverage, or a pharmaceutical company without understanding its patent cliff. Staying within your circle eliminates the vast majority of these potential errors. By refusing to play games you don't understand, you protect your capital from your own ignorance. This leads to significantly lower portfolio volatility and the avoidance of the large, permanent losses of capital that are almost impossible to recover from. A 50% loss requires a 100% gain just to get back to even. The first job of any sound investment strategy is to avoid these devastating setbacks. Second, operating within your circle allows for higher conviction, which in turn permits more concentrated, impactful investments. If you have a shallow understanding of 20 different companies, you will likely allocate your capital timidly across all of them. But if you have a deep, profound understanding of just 3 businesses that you know inside and out, you will have the confidence to make substantial bets when the price is right. Great wealth is not built by diversifying into 100 mediocre ideas. It is built by finding a handful of truly great, simple ideas and investing in them with conviction. This is only possible when those ideas fall squarely within your circle of competence. Think of Buffett's massive multi-billion-dollar investment in Apple. He didn't make that bet because he understands semiconductor design. He made it because he finally understood Apple's business model as a consumer products company with an incredibly sticky ecosystem and immense pricing power. A modern-day See's Candies or Coca-Cola. It fell within his circle of understanding dominant consumer brands. That conviction allowed him to build one of the largest single-stock positions in history, creating hundreds of billions of dollars in value for his shareholders. Finally, it dramatically reduces your research and monitoring costs, both in time and money. The dabbler is constantly spending energy getting up to speed on new industries, a highly inefficient process. The specialist, operating within their circle, can analyze a new company in their industry far more quickly and accurately because they already have the foundational knowledge. They know the key metrics, the competitive landscape, and the industry jargon. This efficiency allows them to focus their energy on what truly matters, valuing the business and waiting for the right price. The financial result of this entire system is a portfolio strategy characterized by lower risk, lower costs, and higher, more concentrated returns over the long term. It is the tangible financial fruit of profound intellectual humility. Having established the critical importance of defining our territory, we must now turn to the second pillar, which is an active and aggressive repulsion of complexity. It is not enough to simply stay within your circle. A core part of this mental model is the conscious and deliberate act of avoiding the 7-foot hurdles. This is about building a psychological immune system against the allure of the difficult puzzle. Smart people are drawn to these puzzles like moths to a flame. The ego tells them that solving a complex problem is a validation of their intelligence. Warren Buffett's genius lies in his recognition that in investing, the game is not scored on difficulty. You get no extra points for buying a complex company that does well versus a simple company that does well. The final score is just the money in the bank. Therefore, the rational approach is to actively seek out the easy games and refuse to play the hard ones. This requires a tool that Buffett and Munger use constantly: the too hard pile. When they look at a potential investment, if they cannot quickly and easily understand its business model, competitive landscape, and future earnings power, they do not spend weeks trying to figure it out. They don't build complex financial models or hire consultants. They simply toss it onto the too hard pile and move on. This is not an admission of failure. It is a declaration of strategic focus. It is the ruthless prioritization of their most valuable asset, their time and attention. They understand that their goal is not to be a universal genius, but to be a highly effective decision-maker within their specific domain. Rejecting complexity is the ultimate act of intellectual efficiency. The most powerful foundational anecdote for this pillar is not about an investment Buffett made, but about a financial catastrophe he masterfully avoided. It's the story of the 1998 collapse of long-term capital management, or LTCM. This was a hedge fund that represented the absolute pinnacle of intellectual arrogance and complexity. Its boardroom was a pantheon of financial gods. It was founded by John Meriwether, the legendary bond trader from Salomon Brothers, and its partners included Myron Scholes and Robert C. Merton, two men who had just won the Nobel Prize in Economics for their work on options pricing, the famous Black-Scholes model. They were, without exaggeration, considered the smartest people in any room they entered. Their strategy was built on extreme complexity. They used sophisticated computer models to identify tiny temporary pricing discrepancies between different securities around the world. For example, they might notice that a 29.5-year U.S. Treasury bond was trading for a fraction of a penny less than a 30-year bond. Their models told them these prices should eventually converge. They would then use massive amounts of borrowed money, leverage, to make enormous bets on these tiny discrepancies. They were picking up nickels in front of a steamroller, but they believed their models were so perfect they could always sidestep the steamroller. For a few years, it worked spectacularly. They generated returns of over 40% annually. They managed over $100 billion in assets on a capital base of less than $5 billion. They were the toast of Wall Street. But their models had a fatal flaw. They were based on historical data from normal market conditions and assumed that human behavior was rational. In the fall of 1998, when Russia defaulted on its debt and a global financial panic ensued, the markets stopped behaving rationally. Correlations that had held for decades broke down. All of their sophisticated bets started going wrong at the same time. The once-in-a-million-years event was happening every day. The fund was in a death spiral, and because of its immense size and leverage, it threatened to take down the entire global financial system with it. The Federal Reserve was forced to intervene. They gathered the heads of the major Wall Street banks in a room to orchestrate a bailout. And who did they call for help, for capital, and for a rational assessment of the situation? They called Warren Buffett in Omaha. John Meriwether pitched Buffett a deal to invest and save the firm. Buffett listened. He saw a room full of geniuses, men with IQs off the charts, who had created a financial black box so complex that even they no longer understood the risks they were taking. They had built a 7-foot hurdle out of esoteric formulas and hubris, and now they were impaled upon it. Buffett's response was swift and decisive. He looked at the labyrinth of over 60,000 trading positions, the extreme leverage, the utter lack of transparency, and he immediately placed it on his too-hard pile. He refused to invest. He was not going to risk Berkshire Hathaway's hard-earned capital on a business he could not understand, no matter how many Nobel laureates were involved. He made a counteroffer on his own simple terms, which was rejected, and he walked away. The big banks ended up bailing out LTCM, but the lesson was seared into the minds of a generation of investors. Intelligence, even Nobel-level genius, is no defense against the destructive power of complexity and leverage. Buffett's decision was a masterclass in the repulsion of complexity. He didn't try to outsmart the geniuses. He didn't try to unravel their Gordian knot of trades. He simply recognized that he was looking at a 7-foot hurdle and, by his own rules, he was not allowed to play that game. This discipline, this refusal to be seduced by the intellectual challenge, is what protected his wealth and his reputation while the smartest guys in the room were facing complete annihilation. It is the ultimate testament to the power of knowing what to avoid. The psychological principle underpinning this aggressive avoidance of complexity is a direct counter-assault on two powerful cognitive biases, the complexity bias and the overconfidence bias. Complexity bias is the brain's subtle and often subconscious tendency to equate complexity with value. We have a built-in assumption that a complex solution is more sophisticated, more intelligent, and therefore better than a simple one. If a doctor gives you a simple diagnosis, you might seek a second opinion. If they give you a highly complex one filled with medical jargon, you're more likely to be impressed and trust their expertise. This bias is exploited constantly in the financial world. Investment advisors sell convoluted products with intricate fee structures, not because they are better, but because their complexity makes them seem more valuable and justifies the high fees. Hedge funds market their proprietary black box algorithms for the same reason. Complexity creates an aura of sophistication that can be very seductive, especially to smart people who appreciate intricate systems. They see a complex investment strategy like the one used by LTCM and think, "This must be brilliant because I can barely understand it." Buffett's too-hard pile is a cognitive kill switch for this bias. It establishes a clear, unbreakable rule. If you can't understand it, it's not sophisticated, it's just opaque. And opacity is the enemy of any sound investment strategy. It severs the connection between complexity and value and replaces it with a connection between clarity and value. The second, and perhaps more dangerous bias at play, is the overconfidence bias. This is the tendency for people to have excessive confidence in their own abilities. This is particularly acute among highly intelligent and successful individuals. Someone who is a top-tier surgeon, a brilliant engineer, or a successful entrepreneur has a long track record of being right. Their intelligence has allowed them to solve difficult problems in their own fields. The overconfidence bias causes them to believe that this success and intelligence will automatically translate to the field of investing. They see a complex business in a field they don't understand, and their inner monologue says, "I'm a smart person, I can figure this out." This is the ego talking. This is the siren song of the 7-foot hurdle. They dive into analyzing a business they have no right to analyze, believing their raw intellect can bridge the gap in their specific knowledge. The partners at LTCM were the poster children for this bias. Their Nobel Prizes gave them absolute, unshakable confidence in their models. They believed they were simply smarter than the market. They believed they had eliminated risk. This overconfidence led them to ignore the simple, ancient wisdom that leverage can kill you and that markets can be irrational longer than you can be solvent. Buffett's mental model is a cage for the ego. By pre-committing to the rule of the too-hard pile, he takes the decision out of the hands of his ego in the moment. The rule is absolute. It doesn't matter how smart he feels or how interesting the puzzle looks. If it's too hard, it's out. This system of pre-commitment is a classic technique in behavioral finance for overriding our own worst instincts. By creating a simple, unbreakable rule, you protect your future self from the emotional and ego-driven temptations that are sure to arise. It is the ultimate form of intellectual risk management. How do you translate this into a practical, applied mental model for your own decision-making? You must build your own too-hard pile. This is not a metaphor. It is a physical or digital tool that will become one of the most important parts of your investment process. Here is the blueprint. Step 1 is to define the criteria for what constitutes too hard. This cannot be a vague feeling. It must be a clear checklist. Here are 5 criteria to start with. First, technological or scientific opacity. Can you explain the company's core technology or product to a teenager in less than 3 minutes? If the company is a biotech firm working on gene editing and you are not a geneticist, it goes in the pile. If it's a software company built on a complex AI algorithm you don't understand, it goes in the pile. Second, financial complexity. When you look at the company's financial statements, do they seem clear and straightforward? Or are they filled with special-purpose entities, complex derivatives, and confusing footnotes? The financials of a company like Enron were deliberately complex to hide fraud. Simplicity and transparency in accounting are a sign of an understandable business. Anything that looks like a labyrinth goes in the pile. Third, regulatory dependence. Does the company's entire business model depend on a specific government regulation, a subsidy, or the outcome of a political process? These factors are inherently unpredictable and outside the realm of business analysis. A solar company whose profits depend entirely on government tax credits is a 7-foot hurdle. It goes in the pile. Fourth, competitive chaos. Is the industry in a state of constant, unpredictable disruption? Think of early-stage tech sectors where dozens of companies are burning cash to gain market share, and it's unclear who the long-term winner will be. Trying to pick the victor in this kind of red ocean environment is a low-probability bet. It goes in the pile. Fifth, a reliance on a single genius. Is the entire company's success seemingly tied to the vision of one irreplaceable founder? While visionary leaders are great, an investment that depends entirely on the health and continued presence of one person is fragile. This introduces a variable you cannot control. It goes in the pile. Step 2 is to create the pile itself. This can be a folder on your computer desktop labeled "Too Hard Pile," or even a physical tray on your desk. When you come across a company that meets one or more of your criteria, you perform a ritual. You save the file to the folder or print out the first page and physically place it in the tray. You do this immediately and without guilt. This physical act reinforces the mental discipline. Step 3 is to never look in the pile again. The purpose of the pile is not to create a to-do list of things to figure out later. Its purpose is to get these seductive but dangerous ideas out of your mind and out of your workflow, so you can focus your limited attention on the simple, high-probability opportunities. This system re-engineers your entire research process. Instead of trying to become an expert on everything, your first job becomes being an expert at exclusion. By ruthlessly culling the complex, you are left with a much smaller, more manageable universe of simple, understandable businesses, the only place where 1-foot hurdles can be found. To fully appreciate the wisdom of this approach, we must examine its antithesis, the path of the puzzle solver. This is the archetype of the intelligent investor who falls victim to complexity bias and overconfidence. The puzzle solver is drawn to investing precisely because of the intellectual challenge. They don't want to buy Coca-Cola. It's too boring, too obvious. They want to be the one who discovers the next Amazon or Tesla before anyone else. They see the stock market as a grand, intricate game of chess, and their goal is to prove they are a grandmaster. The puzzle solver loves speculative technology, companies with big stories but no profits. They'll spend hundreds of hours building intricate spreadsheet models to project the future cash flows of a biotech firm with no approved drugs, or a fusion energy company that is years away from a working prototype. They are fascinated by the complexity of the puzzle. The process of trying to solve it is, for them, the reward. They conflate intellectual stimulation with a sound investment strategy. The historical graveyard of finance is filled with puzzle solvers. The dot-com bubble of the late 1990s was their defining moment. Investors, many of them incredibly smart people from other fields, poured trillions of dollars into internet companies that were often nothing more than a catchy name and a business plan. They had no earnings, no clear path to profitability, and often no real product. But they were complex and exciting. They were about a new paradigm. People built intricate models based on eyeballs and click-through rates to justify insane valuations. They were trying to solve the puzzle of what the internet would become. When the bubble burst, fortunes were vaporized. The simple, boring businesses, like See's Candies, the 1-foot hurdles, sailed through the turmoil, largely unscathed, while the 7-foot hurdles of the new economy bankrupted millions. The puzzle solver's journey is one of high intellectual effort and high emotional volatility. They experience moments of euphoria when one of their complex bets seems to be paying off, but these are inevitably followed by crushing losses when reality intrudes. They are constantly searching for the needle in the haystack, the one revolutionary company that will change the world and make them rich. But they fail to realize that for every one Amazon, there are 1,000 failed pets.coms. Their portfolio strategy is an exercise in buying lottery tickets, albeit ones that require a Ph.D. to understand. They reject the simple, high-probability path to building wealth in favor of a thrilling but ultimately destructive quest to prove their own genius. They fail to learn the lesson of LTCM. In investing, having a 160 IQ does not grant you a license to play a foolish game. The direct financial connection between rejecting complexity and building wealth is one of the most powerful in all of finance. It is about the systematic reduction of what Charlie Munger calls the stupid tax, the money we lose due to our own unforced, ego-driven errors. Every time you avoid a complex, speculative bet that goes to zero, you are not just saving that principal. You are preserving the capital that can then be deployed into a genuine high-probability opportunity later on. The long-term financial impact of simply avoiding the big mistakes is mathematically enormous. But the benefit goes deeper. Simple businesses tend to have far more predictable and less volatile earnings. A company that sells soda or chocolate has a financial future that can be forecast with a reasonable degree of accuracy. A biotech company's future is a binary outcome dependent on an FDA decision. As an investor, owning a portfolio of businesses with predictable cash flows leads to a less volatile, more steadily compounding portfolio. This is reflected directly on a company's financial statements. Simple businesses often have lower capital expenditure requirements, higher returns on equity, and more consistent free cash flow generation. The complexity of a business is often a direct tax on its profitability. Think of the endless R&D spending required for a complex tech firm versus the minimal capital needed to expand a brand like See's Candies. Furthermore, the too hard pile creates an enormous efficiency gain. The time you don't spend trying to understand an impossible business is time you can spend deepening your understanding of a simple one, or simply reading and thinking, which is Buffett's primary activity. This focus allows you to spot the truly great opportunities when they arise, because your mind isn't cluttered with 100 complex and distracting puzzles. The final financial advantage is what happens during a market panic. When fear grips the market, complex, highly leveraged, and unprofitable companies are the first to be sold off indiscriminately. Their stock prices can go to zero because they lack the financial fortitude to survive a crisis. Simple, profitable, well-capitalized businesses, on the other hand, see their stock prices fall, but their underlying business often remains strong. A crisis is the ultimate test of a business model, and simplicity almost always wins. By having a portfolio strategy built around these durable, simple businesses, you not only survive the panics but are positioned to thrive. While others are being wiped out by their complex bets, you are holding the assets that will rebound the strongest, and you will have the mental clarity and financial capacity to buy more of them at bargain prices. The act of rejecting complexity is not a passive strategy. It is an aggressive, offensive move that directly protects your capital and positions you for massive long-term outperformance. We have defined our territory and learned to reject the siren song of complexity. Now we arrive at the third pillar, the inevitability test. This is the framework for identifying the specific characteristics of a one-foot hurdle. It's not enough for a business to be simple to understand. The business itself must be so robust, so dominant, and so simple in its operation that its success feels almost inevitable. It is the search for businesses that, as Buffett has famously quipped, an idiot could run, because, as he follows up, sooner or later, one will. This is not an insult to management, it is the ultimate compliment to the business model. It means the company's competitive advantage is so powerful and its operations so straightforward that it can withstand the occasional misstep or period of mediocre leadership and still produce excellent results for its owners. This pillar is about shifting your focus from forecasting brilliant corporate strategy to identifying invulnerable business structures. It is the search for a durable competitive moat that protects the business from competition, a simple product that is timeless, and a brand that is etched into the psyche of the consumer. These are the businesses that don't need to jump 7-foot hurdles to succeed. they are on a gentle downward slope with the wind at their back. The foundational anecdote that perfectly embodies the inevitability test is Warren Buffett's multi-decade love affair with the Coca-Cola Company. His investment in Coke, which began in 1988, was not based on a complex spreadsheet or a forecast of next quarter's earnings. It was based on a simple, powerful observation of an inevitable business. Buffett had been a consumer of Coca-Cola his entire life, drinking at least 5 cans a day. But it was a trip in the 1980s that crystallized his thinking. He observed the sheer global power of the brand. He saw people in remote corners of the world, with little disposable income, still choosing to spend their money on a small bottle of Coke. He realized that the name Coca-Cola was one of the most valuable pieces of real estate in the world, the real estate in the consumer's mind. He began to analyze the business model and saw its breathtaking simplicity and power. Coca-Cola was not primarily in the bottling business, which is capital-intensive and low margin. It was in the syrup business. It manufactured a secret formula concentrate, sold it to bottlers all over the world, and then reaped a royalty on every single can or bottle sold. The business required almost no additional capital to grow. If an extra billion people decided to drink Coke, the company didn't need to build billions of dollars in new factories. The bottlers did. Coca-Cola just had to ship more syrup. This created an economic engine with astronomically high returns on invested capital. He saw a business that passed the idiot-proof test with flying colors. The brand was so powerful, the product so simple and desired, that it could tolerate a series of mediocre CEOs and still gush cash. Its success was not contingent on the next brilliant innovation or a single genius executive. Its success was driven by the simple, repeatable act of billions of people every day choosing to drink a product they knew and trusted. In 1988, the market was in a state of panic following the Black Monday crash of 1987. People were terrified of stocks. But Buffett saw this as his opportunity. He looked at Coca-Cola's stock price and realized the market was valuing this incredible global institution as if it were just another average company. He saw a massive discrepancy between the price of the company and its intrinsic, inevitable value. Over a period of several months, Berkshire Hathaway invested over $1 billion to acquire roughly 7% of the company. It was, at the time, one of the largest single investments ever made, and a huge bet for Berkshire. People thought he was crazy for paying such a high multiple for a seemingly mature business. But Buffett wasn't buying a stock, he was buying a piece of a global inevitability. He was stepping over a 1-foot hurdle that the rest of the market, blinded by fear and short-term thinking, perceived as a wall of risk. That $1 billion investment has since paid tens of billions of dollars in dividends back to Berkshire and has appreciated in value to be worth well over $20 billion today. The Coca-Cola story is the ultimate example of the inevitability test. It is a lesson in focusing on the qualitative, durable strengths of a business, its brand, its simple economic engine, and its timeless appeal, rather than getting lost in the quantitative noise of short-term market fluctuations. The underlying psychological principle that makes the inevitability test so effective is its ability to harness and redirect our natural biases. Specifically, it leverages the availability heuristic while protecting us from the dangers of confirmation bias. The availability heuristic is a mental shortcut that relies on immediate examples that come to a given person's mind when evaluating a specific topic. We tend to judge the likelihood of an event by how easily we can recall an example of it. Buffett uses this to his advantage. When he analyzes a company like Coca-Cola or American Express, the evidence of their dominance is readily available. You see their products and services everywhere, every single day. You don't need to dig through obscure technical journals to understand their value proposition. The power of the brand is right in front of you. This makes the analysis simpler and more grounded in reality. He is not trying to predict a future that is difficult to imagine. He is extrapolating a present that is easy to observe. This reliance on readily available, overwhelming evidence of a company's success reduces the chances of being wrong. Instead of trying to guess which of 500 biotech startups will find a cure for a rare disease, he is betting that people will continue to drink the world's most popular beverage. It's a high probability bet because the evidence supporting it is ubiquitous. However, the search for inevitable-seeming businesses must be paired with a defense against its close cousin, confirmation bias. This is the tendency to search for, interpret, favor, and recall information in a way that confirms or supports one's pre-existing beliefs. If an investor becomes enamored with a company, they will start to see only the positive news and dismiss the negative. They'll fall in love with the story and lose their objectivity. The idiot-proof component of the inevitability test is the defense mechanism against this. By specifically asking, could a bad CEO harm this business, you are forcing yourself to look for vulnerabilities. You are actively seeking disconfirming evidence. A truly inevitable business is one where even after searching for weaknesses, you find that the structural moat is just too strong. For example, you might love the idea of a certain airline. Confirmation bias would lead you to focus on its growing routes and new planes. The inevitability test would force you to ask, what if an incompetent CEO starts a price war? You would quickly realize that the airline industry is incredibly fragile, with high fixed costs, brutal competition, and sensitivity to fuel prices. A single bad leader could bankrupt the company. It is not an idiot-proof business. This simple question acts as a firewall, allowing you to benefit from the obviousness of great companies, availability heuristic, while stress testing that conclusion to protect you from falling in love with a flawed idea, confirmation bias. It ensures that your perception of inevitability is based on structural reality, not just a good story. So how can we systematize this into a practical blueprint? You can create what I call the idiot-proof business audit, a checklist to run any potential investment through. This mental model translates the abstract idea of a great business into a concrete set of questions. Here are the 5 key questions in the audit. Question 1, the 10-year test. Is the company's core product or service essentially the same as it was 10 years ago? And is it likely to be the same 10 years from now? This is a test for timelessness. A company like Wrigley's, which sells chewing gum, passes this test easily. A cutting-edge technology company likely does not. We are looking for businesses that benefit from a lack of change, not those that are constantly threatened by it. Question 2, the gross margin test. Does the company have consistently high gross margins? Gross margin, revenue minus cost of goods sold, is a powerful indicator of a competitive moat. A company that can charge a high price relative to its input costs likely has something special, a strong brand, a patent, or a unique service. Coca-Cola's gross margins are famously high because the cost of syrup is tiny compared to the price it commands. A company in a brutally competitive commodity business, like a steel mill, will have thin margins. Look for a history of strong, stable gross margins. Question 3, the brand power test. If the company's products were removed from the shelves and replaced by a generic equivalent with the exact same ingredients, would the customer care? Would they still seek out the original brand? For a can of Coke, the answer is a resounding yes. For a generic pain reliever, perhaps not. This is a gut check for the power of the brand as a competitive advantage. It's about the moat in the consumer's mind. Question 4, the capital test. Does the business require huge, continuous infusions of capital to grow and stay competitive? Railroads, for example, are notoriously capital-intensive. They constantly need to spend billions on tracks and trains. A business like Moody's, the credit rating agency, requires almost no capital to grow. It's an information business. We are searching for businesses that gush cash, not ones that consume it. Look for a history of high returns on tangible assets. Question 5, the ham sandwich test. This is the ultimate question. Write down the top 3 things that could destroy this business. Then ask yourself, could a new, mediocre CEO, the proverbial ham sandwich, avoid these pitfalls simply by not making any radical changes? If the business runs on a kind of autopilot due to its structural advantages, it passes. If it requires a genius visionary at the helm to constantly navigate existential threats, it fails. By running every potential investment through this 5-question audit, you force yourself to focus on the long-term, structural characteristics of a business. You move beyond the noise of quarterly earnings and analyst ratings and begin to think like an owner. This audit is your tool for systematically identifying the 1-foot hurdles in a world full of 7-foot walls. What does the opposite path, the path of the 99%, look like? It is the path of the turnaround artist. This investor is a romantic. They are not interested in buying wonderful, successful businesses. They are drawn to the drama of the comeback story. They love to sift through the wreckage of the stock market, looking for beaten-down, broken companies. They hunt for stocks trading for pennies, believing they can find the one that will rise from the ashes. Their hero is not the steady compounder, but the speculative bet that goes up 1,000%. The turnaround artist is seduced by cheapness. They see a company whose stock has fallen 90% and think, it can't go any lower. They fail to realize that a stock that has fallen 90% is one that has already lost 80%, and then lost 50% from there. It can, and often does, go another 90% lower. They violate a key Buffett principle. It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. The turnaround artist is constantly trying to do the latter. They buy failing retailers, hoping for a comeback. They invest in old technology companies that have been disrupted, believing their patents hold some hidden value. They are betting on the most difficult act in business: resurrection. The problem is that for every successful corporate turnaround, there are 100 failures. Problems in a business are rarely singular. When a company is in decline, it's often like an infestation of termites. You might see one, but there are 1,000 more in the walls. The turnaround artist thinks they can fix the one problem they see, not realizing the entire foundation is rotten. This investment strategy is emotionally and financially draining. It requires immense amounts of time and research to determine if a broken company is even fixable, and even if it is, the odds are long. Buffett himself learned this lesson the hard way. His purchase of Berkshire Hathaway, the original textile mill, was a classic turnaround investment. It was a dying business in a terrible industry. He spent 2 decades fighting a brutal headwind, trying to keep it alive. He later admitted that this was a monumental mistake. The money and effort he poured into that failing textile mill would have been infinitely more productive if he had invested it in a wonderful business like Coca-Cola from the start. The path of the turnaround artist is paved with these cigar-butt businesses. It is an exhausting, low-probability quest that ignores the simple, powerful logic of buying the best and letting them run. It is the choice to climb a sheer cliff face instead of walking up a gentle slope. The financial connection between the inevitability test and your bottom line is the magic of long-term compounding. A truly great, idiot-proof business is a compounding machine. Because it doesn't require much additional capital and generates high returns on the capital it does employ, it produces a constant stream of excess cash. This cash can then be reinvested or returned to shareholders, who can reinvest it themselves. This creates a virtuous cycle. Let's quantify this. Imagine a mediocre capital-intensive business that earns a 6% return on equity. Now imagine a wonderful, simple business like See's Candies that consistently earns a 25% return on equity. Over 30 years, a $100,000 investment in the first business, with all earnings reinvested, will grow to about $574,000. The same investment in the second business will grow to over $80 million. This is not a typo. That is the explosive, non-linear power of high-quality compounding. This is the financial engine that turned Buffett from a millionaire into a centibillionaire. The inevitability test is a search for these elite compounding machines. On a balance sheet, this is reflected in a consistently high return on equity, ROE, and return on invested capital, ROIC, with low debt. In an investment portfolio, it translates into a smooth, upward-sloping curve of value over decades, rather than the jagged, volatile movements of speculative or cyclical stocks. Furthermore, these inevitable businesses provide incredible inflation protection. Companies with strong brands and pricing power like Coca-Cola or American Express can pass on rising input costs to their customers. Their profits are not eroded by inflation. Commodity businesses, on the other hand, get squeezed. Their costs go up, but they have no power to raise their prices, so their margins get crushed. In an inflationary environment, the quality of the business you own becomes paramount. Owning a portfolio of these inevitable businesses is like owning a collection of financial fortresses. They are resilient in recessions, protected from inflation, and they churn out ever-increasing streams of cash, year after year. The direct financial benefit isn't just about picking a few winners. It's about building a portfolio with a structural, long-term mathematical advantage over the rest of the market. It is the closest thing to a guarantee of building real, lasting wealth. We have now learned to define our territory, to reject complexity, and to identify the specific qualities of a one-foot hurdle. This brings us to the fourth pillar, a principle that is simple to understand but incredibly difficult to execute: the power of inaction. This is the profound discipline of patience. Stepping over one-foot hurdles requires you to first find them, and the brutal reality of investing is that they are rare. The market does not serve up wonderful, inevitable businesses at bargain prices every day. They appear only sporadically, often during times of widespread market fear or turmoil. The average investor feels a constant pressure to do something. They believe that activity equals progress. They are constantly tinkering, buying and selling. Buffett's philosophy is the polar opposite. He has described his ideal investment style as lethargy bordering on sloth. His favorite holding period is forever. This is not laziness, it is a strategic weapon. The power of inaction is the ability to sit, for months or even years, with cash in hand, patiently waiting for the perfect pitch, the one-foot hurdle, to cross the plate. It is the understanding that in investing, you don't have to swing at every pitch. You can wait for the one that is right in your sweet spot, where you are almost certain to get a hit. This patience is perhaps the greatest and rarest advantage an investor can possess. The foundational anecdote that illustrates this pillar is not a single transaction, but a long, frustrating period of discipline, the years leading up to the 2008 financial crisis. From roughly 2004 to 2007, the stock market was in a state of euphoria. Private equity firms were executing massive leveraged buyouts, housing prices were soaring, and complex financial instruments like collateralized debt obligations were all the rage. Credit was cheap, and risk was being ignored. During this time, Warren Buffett was largely on the sidelines. Berkshire Hathaway's cash pile grew and grew, swelling to over $40 billion. Wall Street and the financial media began to whisper that Buffett had lost his touch. They called him old, out of sync with the new paradigm of finance. He was criticized for being too conservative, for sitting on a mountain of unproductive cash that was earning a pittance in short-term treasury bills. The pressure to do something with that money was immense. Shareholders grumbled, pundits pontificated. Yet Buffett did nothing. He and Munger continued to look for one-foot hurdles, great, simple businesses at reasonable prices, and they simply could not find any. The market was too frothy. Prices were too high, and the deals being done were too reckless and complex. So he waited. He patiently endured the criticism and the opportunity cost of holding cash in a rising market. He was exercising the power of inaction on a massive scale. Then, in the fall of 2008, the world changed. Lehman Brothers collapsed. The global financial system seized up. The euphoria turned to blind panic. The 7-foot hurdles that Wall Street had been gleefully jumping over all came crashing down. And suddenly the man who had been called a dinosaur was the only person with both the cash and the credibility to save the system. His phone began to ring off the hook. In the depths of the crisis, when capital was scarcest and fear was at its peak, Buffett became the lender of last resort to corporate America. He made a $5 billion investment in Goldman Sachs and a $5 billion investment in General Electric. Later, he would make another $5 billion investment in Bank of America. These were not ordinary stock purchases. These were brilliantly structured deals that were only available to him because he had the cash when no one else did. He received preferred stock with massive dividend yields, 10% in the case of Goldman Sachs, plus warrants, which were essentially long-term options to buy common stock at crisis-level prices. He was not catching a falling knife. He was being paid handsomely to provide the capital and confidence that the market desperately needed. These investments were spectacular one-foot hurdles served up by panic. He understood these great American institutions, and he was able to buy them at prices that offered an immense margin of safety. The deals he made in that short window of crisis would go on to generate tens of billions of dollars in profits for Berkshire. This entire episode was a masterclass in the power of inaction. His ability to do nothing for years during the boom was the direct prerequisite for his ability to do everything during the bust. Patience is not a passive state. It is the active stockpiling of financial and psychological capital for the moment when it is needed most. The psychological principle that makes patience so powerful and so difficult is its direct conflict with two of our most ingrained cognitive biases: action bias and the fear of missing out, or FOMO. Action bias is the human brain's default setting to favor action over inaction, even when there is no rational evidence that action will lead to a better outcome. In our evolutionary past, this made sense. If you heard a rustle in the bushes, it was better to run, action, than to sit and analyze the situation, inaction. This bias carries over into the modern world. We believe that being busy is being productive. In investing, this manifests as the constant need to trade, to adjust a portfolio, to react to every news headline. Sitting on cash feels like passivity, like failure. The hyperactive trader is a victim of action bias. They are constantly churning their portfolio, racking up fees and taxes, mistaking the motion of trading for the progress of investing. Buffett's philosophy of lethargy bordering on sloth is a conscious and deliberate rebellion against this bias. He understands that in investing, the costs of making a bad decision are often far higher than the costs of missing a mediocre opportunity. Therefore, the default setting should be inaction. Action should only be taken when an opportunity is so compelling that the decision is obvious. He has a 20-slot punch card rule in his head. Imagine you have a card with only 20 punches on it for your entire investment life. Each time you make an investment, you punch a hole. With such a finite number of decisions, you would be incredibly careful and deliberate about each one. This mental model forces a shift from a mindset of action to one of extreme selectivity. The second demon is FOMO. This is a powerful social and emotional anxiety that you are missing out on a rewarding experience that others are having. In the late 1990s, investors who were holding boring value stocks felt intense FOMO as their neighbors got rich on .com stocks. In the years before 2008, Buffett felt the pressure of FOMO as private equity firms were making billions on leveraged deals. FOMO is driven by herd mentality. We see others making money, and we feel a primal urge to join in, often without understanding what we are buying. This is what inflates bubbles and what causes investors to pile in at the top, right before a crash. Patience is the ultimate antidote to FOMO. It is the quiet confidence to stick to your own well-defined process, even when it is out of favor. It is the understanding that the goal is not to catch every trend, but to achieve excellent long-term results with a high degree of certainty. It requires detaching your ego from the short-term performance of the market and tying it instead to the disciplined execution of your strategy. By cultivating the ability to sit quietly and do nothing, you build a psychological fortress that is impervious to the manias and panics that whip the majority of investors back and forth, from greed to fear and back again. How can you apply this principle and build the discipline of patience? The blueprint is to create a cash discipline mental model for your own personal finance and investment strategy. This is a set of rules that governs how you handle cash and forces you to be more selective. Step 1. The Opportunity Fund. Segregate your capital. Instead of having one big pot of investment money, create a specific, designated account called your Opportunity Fund. This is cash that is explicitly set aside to wait for a 1-foot hurdle. It is not to be used for ordinary, everyday investing. By giving it a name and a purpose, you change your psychological relationship with it. It is no longer unproductive cash. It is dry powder waiting for a great opportunity. This simple reframing can help combat the action bias. Step 2. The hurdle rate rule. You must define your minimum acceptable standard for an investment before you look for one. Create a written investment policy statement that includes a hurdle rate, a minimum projected rate of return you require before you will deploy capital from your opportunity fund. For example, you might decide that you will not act unless you believe an investment has a very high probability of delivering a 15% annualized return over the next decade. This is your personal quality filter. During frothy markets, you will find that almost nothing meets this criterion. This rule prevents you from lowering your standards just because you feel impatient. It forces you to say no over and over again. Step 3. The Market Panic Plan. You must decide in advance how you will behave during a market crash. A panic is not the time to be making up a plan. It is the time to be executing one. Write down a simple plan. For example, when the S&P 500 falls 20% from its peak, I will deploy 25% of my opportunity fund into a broad market index fund. If it falls 30%, I will deploy another 25%. Having this pre-committed plan helps to override the deer-in-the-headlights paralysis that strikes most investors during a crash. It turns a moment of fear into a trigger for disciplined action. Step 4. The Information Diet. To cultivate patience, you must control your information intake. Stop watching the daily financial news. Stop checking your stock portfolio every day. These activities are designed to trigger your action bias and FOMO. Instead, schedule a time once a week or once a month to review your portfolio and read high-quality, long-form investment writing. Your goal is to shift your time horizon from days and weeks to years and decades. Patience is like a muscle. It must be trained. This 4-step blueprint, the Opportunity Fund, the Hurdle Rate Rule, the Market Panic Plan, and the Information Diet, is a workout regimen for that muscle. It provides a structure for inaction and a trigger for disciplined action, transforming patience from a passive virtue into a powerful strategic tool for building wealth. The antithesis of this patient approach is embodied by the hyperactive trader. This individual views the stock market as a video game. Their screen is filled with flashing tickers, real-time charts, and breaking news alerts. They are addicted to the adrenaline of the trade. They get up early to trade the pre-market, and they stay up late to trade the after-hours. They are not investing in businesses, they are renting stocks. The hyperactive trader is obsessed with the short term. They are trying to predict whether a stock will go up or down in the next hour, the next day, or the next week. They base their decisions on technical analysis, reading patterns in charts, or on the latest news headline or analyst upgrade. They are constantly jumping in and out of positions, convinced that they can outsmart the market's daily whims. This path is almost guaranteed to lead to financial failure for 2 simple mathematical reasons: costs and taxes. Every time the hyperactive trader buys or sells, they incur a transaction cost, either a direct commission or the indirect cost of the bid-ask spread. These small costs act like a constant friction on their portfolio, grinding away their returns. Even more damaging are taxes. If they hold a stock for less than a year, any profit is taxed as short-term capital gains, which are taxed at the same high rates as ordinary income. A long-term investor who holds a stock for more than a year pays a much lower long-term capital gains rate. By trading constantly, the hyperactive trader is giving up a huge portion of any potential winnings to the government. They are playing a loser's game, where the odds are structurally stacked against them by the very system they are trying to master. Beyond the financial costs, there is a massive emotional and psychological cost. The life of the hyperactive trader is one of constant stress and anxiety. Their mood rises and falls with the meaningless squiggles on a screen. They have no peace of mind because their financial well-being is tied to the chaotic, unpredictable noise of the short-term market. They mistake this frantic activity for a sophisticated investment strategy, but in reality, it is just a form of expensive entertainment. They are the polar opposite of Buffett, who famously said, "The stock market is a device for transferring money from the active to the patient." The hyperactive trader is, by their very nature, always on the wrong side of that transfer. The direct financial connection of strategic patience is arguably the most powerful of all the pillars. It creates what is known as a liquidity premium. This is the excess return you can earn by providing liquidity, cash, to the market when it is most desperate for it. In normal times, cash earns very little, but in a crisis, cash becomes king. When everyone is forced to sell assets to raise cash, the price of those assets plummets. A patient investor with a hoard of cash can step in and name their price. This is what Buffett did in 2008. The deal he got from Goldman Sachs, 10% annual dividend plus warrants, was a return that was mathematically impossible to achieve in a normal market. He earned this enormous liquidity premium because he had the patience to hold cash for years when it was unpopular. This ability to act decisively during a panic can generate a decade's worth of returns in a single year. On your personal balance sheet, a large cash position acts as a powerful hedge. It is a form of portfolio insurance that is not only free, but actually pays you for holding it through the opportunities it will eventually provide. Furthermore, a long holding period dramatically increases the tax efficiency of your portfolio. By minimizing turnover and holding investments for many years, you allow your capital to compound pre-tax for as long as possible. The difference between compounding at a pre-tax rate versus an after-tax rate is enormous over time. Let's say you earn a 12% return and are in a 30% tax bracket for short-term gains. The hyperactive trader earns 12%, immediately loses 3.6% to taxes, and is left with an 8.4% after-tax return. The patient investor earns 12%, defers the tax for decades, and allows the full 12% to compound. Over 30 years, $100,000 in the trader's account grows to about $1.1 million. In the patient investor's account, it grows to nearly $3 million. The difference is not due to a better investment strategy, but simply the financial advantage of inaction. Patience is not just a virtue, it is a powerful financial catalyst that reduces costs, minimizes taxes, and uniquely positions you to seize the rare, life-changing opportunities that markets inevitably provide. This brings us to the fifth and final pillar, the one that connects all the abstract principles to a hard, numerical reality, the margin of safety. This concept, first taught to Buffett by his mentor Benjamin Graham, is the bedrock of value investing. It is the ultimate financial expression of a one-foot hurdle. The principle is simple. An investment must be purchased at a significant discount to its underlying intrinsic value. Intrinsic value is the true, underlying worth of a business, based on the cash it will generate over its lifetime. The market price is what the business is selling for today. The margin of safety is the gap between these two numbers. If you calculate a business is worth $100 per share and it is trading for $95, you have no margin of safety. If it is trading for $60, you have a $40 margin of safety. This discount is your protection against bad luck, errors in judgment, and the unpredictable vicissitudes of the economic world. It is the financial shock absorber that ensures that even if your analysis is a little bit wrong, you are unlikely to suffer a permanent loss of capital. It is the quantifiable measure of just how low the hurdle is. A wide margin of safety is the definition of a one-foot hurdle in financial terms. The foundational anecdote for the margin of safety principle is one of the most brilliant investments of Buffett's early career, a moment that proved his genius and launched him onto the national stage. It was the salad oil scandal of 1963. The protagonist was a company everyone knew, American Express. At the time, Amex had two core wonderful businesses, their charge card and their traveler's checks. But they also had a much smaller, sleepier division in warehousing. This division would inspect a company's inventory, like barrels of vegetable oil, and then issue receipts against that inventory, which the company could then use as collateral for loans. One of its clients was a company called Allied Crude Vegetable Oil, run by a man named Tino DeAngelis. DeAngelis was a fraudster. He had discovered that he could fill his giant storage tanks mostly with water, with only a thin layer of salad oil on top. When inspectors came, they would measure from the top and see oil. He used this trick to get receipts for millions of pounds of oil that didn't exist. He then used these fraudulent receipts to get massive loans. In November of 1963, the fraud was discovered, and Allied Crude went bankrupt, defaulting on over $175 million in loans, a colossal sum at the time. Since the loans were backed by American Express's receipts, Wall Street panicked. They assumed Amex would be on the hook for the entire amount, which would have wiped out the company. The stock collapsed, falling nearly 50% in a matter of weeks. The herd was selling in a state of utter terror. This is where the young Warren Buffett saw not a crisis but an opportunity. He did not panic. He started by analyzing the situation from a circle of competence perspective. He realized that while the warehousing division was a disaster, the real value of American Express lay in its card and traveler's check businesses. The crucial question was whether the scandal had damaged the brand in the minds of consumers. So he did what Ben Graham had taught him. He went out and did the legwork. He went to restaurants and travel agencies. He talked to merchants and customers. He asked them, "Are you still accepting the American Express card? Are people still buying the traveler's checks?" The answer he got back, over and over, was yes. The scandal was a Wall Street story. It had not affected the consumer's trust in the core products. The moat was intact. Having confirmed the qualitative strength of the business, he then turned to the quantitative analysis, the margin of safety. He calculated that even in a worst-case scenario, where Amex was held liable for a significant portion of the fraudulent loans, the company's powerful earning potential from its core businesses meant it was still worth far more than its beaten-down stock price. He calculated the intrinsic value per share to be around $60. The market, in its panic, was selling the stock for as low as $35. This was a massive margin of safety. The market was offering him $1 worth of business for less than 60 cents. He invested over 40% of his partnership's capital into American Express stock, making it his single largest investment. Over the next 2 years, as the company settled the legal claims for far less than anticipated and the power of its core business continued to shine, the stock price tripled. The salad oil scandal was a masterclass in applying the margin of safety. It demonstrated how a rational, quantitative approach can allow an investor to override the powerful emotions of fear and greed. While the rest of the world was panicking about a temporary, solvable problem, Buffett was calmly buying a wonderful business at a price that provided a huge buffer against error and a massive potential for upside. The underlying psychological principle that makes the margin of safety so crucial is its function as a direct antidote to two of the most powerful and primal emotions in finance: loss aversion and herd mentality. Loss aversion is a cornerstone of behavioral economics, discovered by psychologists Daniel Kahneman and Amos Tversky. They found that for the human brain, the pain of a loss is psychologically about twice as powerful as the pleasure of an equivalent gain. Losing $100 feels as bad as winning $200 feels good. This is hardwired into our survival instincts. This is why market panics are so violent. When investors see their portfolio values dropping, the pain of loss aversion kicks in, creating an overwhelming urge to sell at any price, just to make the pain stop. This is what drives people to sell at the bottom. The margin of safety is a rational, analytical shield against this destructive emotion. By anchoring your decision-making to a calculated intrinsic value, you create a new frame of reference. When a stock you bought for $60, which you believe is worth $100, falls to $50, your brain doesn't just see a $10 loss. Your analytical mind sees an even bigger gap between price and value. The margin of safety has actually increased. This provides the psychological fortitude to not only hold on, but to potentially buy more. It replaces the emotional question, how much more can I lose, with the rational question, how much cheaper is this wonderful business now? The second principle it counters is herd mentality, our innate tendency to follow the actions of a larger group. In the wild, this kept us safe. In the market, it is a recipe for disaster. When everyone was selling American Express during the salad oil scandal, the social pressure to join the herd was immense. Going against the crowd is psychologically difficult. It feels isolating and risky. The margin of safety provides the independent, objective logic needed to stand apart from the herd. Your conviction comes not from what others are doing, but from your own conservative calculation of value. If your analysis shows a stock is worth $100 and the herd is selling it at $60, you don't need their approval to know it's a good decision. You have your own anchor of reality in a sea of emotional chaos. Ben Graham wrote, "You are neither right nor wrong because the crowd disagrees with you. You are right because your data and reasoning are right." The margin of safety is the tool that allows you to ground your reasoning in data, liberating you from the powerful and often irrational pull of the crowd. It is the final defense that allows a rational investor to behave rationally in an irrational world. So how do you apply this? How do you create a margin of safety in your own investments? The blueprint is a simplified valuation model I call the back-of-the-envelope valuation. The goal here is not to create a complex, 100-tab spreadsheet that gives you a false sense of precision. The goal is to quickly determine if a business is so obviously cheap that a deep dive is warranted. It's a filter, not a final answer. Step 1. Find the owner earnings. Go to a company's financial statements, available for free on sites like Yahoo Finance, and look at the cash flow statement. Find the cash flow from operations. This is a good starting point for the cash the business is actually generating. Now go to the same statement and find capital expenditures. This is the money the company has to spend on equipment and facilities just to stay in business. A simple, conservative estimate of owner earnings, the cash that is truly available to the owners, is cash flow from operations minus capital expenditures. Do this for the last 5 years and get an average to smooth out any lumpy years. Let's say you find a company with average owner earnings of $1 billion per year. Step 2. Apply a conservative multiple. Now you have to ask, what is a fair price to pay for this $1 billion stream of earnings? This is where the art comes in. A fantastic, growing, stable business might deserve a multiple of 20 times earnings. A mediocre, cyclical business might only deserve a multiple of 10. For this exercise, we must be conservative. Let's use a multiple of 15, which is roughly the long-term average for the stock market. So $1 billion in owner earnings times a multiple of 15 gives us an estimated intrinsic value for the entire company of $15 billion. Step 3. Compare to the market price. Now look up the company's market capitalization, its total stock market value. If the market cap is, say, $14 billion, you have a small margin of safety, but probably not enough. If the market cap is $20 billion, it's clearly overpriced. But if the market cap is $7.5 billion, you have a 50% margin of safety. You are being offered the chance to buy the company for half of its conservatively estimated worth. This is a 1-foot hurdle. This back-of-the-envelope calculation is not perfect, but that's the point. As Buffett says, it's better to be approximately right than precisely wrong. If the margin of safety isn't immediately obvious and massive from this simple calculation, then it's not a big enough opportunity to warrant your time. This process forces you to be a business analyst, not a market speculator. It anchors your decisions in the value of the underlying business, not its fleeting stock price. It is the practical, numerical application of the entire philosophy we have discussed, the final step in identifying a 1-foot hurdle you can confidently step over. Finally, we must look at the antithesis, the path that leads the vast majority of investors astray, the path of the price chaser. This investor has no concept of intrinsic value. For them, the only signal that matters is the stock's price itself. If a stock is going up, they believe it is a good stock. If it is going down, it is a bad stock. Their entire strategy is based on momentum. They buy high, hoping to sell even higher. The price chaser is a pure creature of emotion, driven entirely by the greed of seeing a stock rise and the fear of missing out. They see a stock like Tesla or Nvidia soaring, and they pile in at the top, not because they have done a rigorous analysis of the business, but simply because the line on the chart is going up and to the right. They are the fuel for the final, manic phase of every market bubble. Conversely, when a great company's stock falls due to a temporary problem like American Express during the scandal, the price chaser is the one selling in a panic. The falling price is their only signal, and it tells them to run for the exits. This guarantees they will do the exact opposite of what a successful investor must do. They will consistently buy high and sell low. The price chaser's portfolio is a mirror of market sentiment. It is filled with the hot stocks of the moment, purchased at inflated prices, and devoid of the wonderful but temporarily unloved businesses that offer a true margin of safety. They are playing a game with no anchor, tossed about by the waves of market psychology. Their fate is to provide the profits for the patient, value-oriented investors who are on the other side of their trades, the ones who are happily selling them overpriced stocks in a frenzy and eagerly buying their discarded shares in a panic. The path of the price chaser seems easy and exciting in the short term, but it is a one-way ticket to long-term financial disappointment. It is the inevitable result of ignoring the anchor of intrinsic value and the life raft of the margin of safety. The direct financial connection of the margin of safety is the most important of all: downside protection and an improved risk/reward ratio. Investing is a game of probabilities. You will not be right 100% of the time. The margin of safety is the principle that ensures that when you are wrong, you don't lose much, and when you are right, you win big. Let's quantify it. If you buy a stock that you think is worth $100 for $95, and it turns out you were wrong, and it's only worth $80, you've lost 15% of your capital. If you buy that same stock for $60, and you are wrong by the same amount and it's only worth $80, you've still made a 33% profit. The margin of safety created an asymmetric risk/reward profile. Your upside potential is many multiples of your downside risk. This is the secret to long-term success. By consistently making bets where the odds are skewed heavily in your favor, you don't need to be a perfect prognosticator to build immense wealth. You just need to be rational and disciplined. On a portfolio level, a strategy built around a margin of safety will exhibit significantly lower volatility and smaller drawdowns during market downturns. It provides a structural resilience that momentum-based strategies lack. When a market bubble pops, the stocks with the highest valuations and no margin of safety fall the hardest. The undervalued, solid businesses may fall, but they fall less, and they recover faster, because their price is already anchored to a real, tangible business value. The ultimate financial advantage is peace of mind. Investing with a margin of safety eliminates the constant, gnawing anxiety that comes with speculation. You own a collection of good businesses, purchased at sensible prices. You can sleep at night, confident that you have not exposed yourself to the risk of catastrophic, permanent loss. This is the final promise of the one-foot hurdle philosophy. It is not just a strategy for getting rich. It is a framework for staying rich, for building a financial life based on prudence, discipline, and the quiet confidence that comes from stacking the odds overwhelmingly in your favor. You have just spent this time acquiring a powerful mental tool. You've rewired your perspective. You no longer see simplicity as a compromise for the unsophisticated, but as the ultimate strategic advantage of the truly intelligent. You now understand that the goal isn't to prove your genius by solving the most complex puzzle in the market, but to channel that genius into the disciplined search for the obvious, the simple, the inevitable, the one-foot hurdle you can step over with grace and confidence. You now possess the 5 pillars of that system, defining your circle of competence: the aggressive repulsion of complexity, the inevitability test, the strategic power of inaction, and the quantitative shield of the margin of safety. This is a complete framework for turning your intelligence from a potential liability into your greatest asset. But it's crucial to understand that Buffett's system is not just a collection of disconnected ideas, it is a network, an interlocking architecture of mental models where each piece reinforces the others. What you have just mastered is a critical part of the equation, the framework for identifying times what to buy and times how to value it. But there is another side to this coin, a dimension that is arguably even more difficult and more important. It is the psychological architecture required to execute this strategy over a lifetime. How did Buffett develop the almost superhuman patience to sit on his hands for years, weathering the criticism and the intense fear of missing out, waiting for that single moment of crisis when he could act? What is the mental wiring that allows a person to be greedy when others are fearful, and fearful when others are greedy not just once, but time and time again for over 60 years? The video that is now on your screen is the missing link. It is the other half of the map. It moves beyond the what and dives deep into the how. It deconstructs the psychological conditioning and the behavioral habits that create the emotional fortitude required for long-term success. It is the bridge between knowing the strategy and having the character to implement it. To understand the one-foot hurdle is the first step. To build the mindset that can patiently wait for it and act without hesitation when it appears is the final ascent. This isn't about simply watching another video. This is a conscious decision about the kind of investor, the kind of decision maker you are becoming. The undisciplined amateur, the dabbler, the hyperactive trader, they are defined by constant, anxious action. The professional is defined by long periods of patient preparation, followed by short bursts of decisive, confident execution. To continue your journey into that professional mindset, to complete the mental arsenal you have begun to build today, the path is right there in front of you. The choice to continue is the choice to complete the promise.